Hey guys, Ken from Investing Made Easy here. Today I'm going to be talking about growth stocks versus value stocks. But before we start, make sure to like, comment and subscribe for future videos. As per usual, this is not professional financial advice, but merely my opinion on what I think about the situation. So what is a value stock? A value stock is a stock that is trading at a lower price than its fundamentals seem to indicate, and is therefore considered to be undervalued by the investor. So, for choosing value stocks, we'll be using fundamental analysis. So check out my video on this topic in the top right if you're unsure about what this is. Right, so what are we searching for in a value stock? All of the items I'm about to talk about are indicators of undervaluation. Firstly, a high earnings per share. This means that a company is making a certain amount of money for every dollar that you spend on that share. A high number means the company is more profitable per share. A low P to E ratio is also important. This is very similar to a high earnings per share. The lower the number, the more profits a company is making for that same dollar that you have invested. Thirdly, a reasonable PEG or projected earnings growth. Reasonable in this case means that although the number should be high, as this is a good indicator of future growth, it should also be achievable. Otherwise the figure is meaningless and could mean the company is untrustworthy and trying to tempt novice investors. A low P to B ratio is also a good indicator for undervaluation. Buying a company that is undervalued gives you the best odds for a higher return, as you're able to buy a larger stake in the company and therefore experience higher growth. And finally, the dividend yield. This is the yearly dividend compared to the share price. This is what percentage annually you'll get back on the shares you own. This is a great way of building passive income. This can also be an indicator of an undervalued company. If the company's dividend yield is higher than its 5-year average, it can mean the company is undervalued. This is for two reasons. The company may feel that its share price is undervalued and therefore is attempting to attract investors with a high dividend yield, or that the company is doing really well and believes sharing its profits with the investors is a good idea. This dividend yield is what provides you with that passive income that makes value stocks better for the long term. Okay, now on to growth stocks. Growth stock funds are the funds that hold growth stocks, which are the stocks of a company that are expected to grow at a rate faster in relation to the overall stock market. So what can we do when looking for stock growth? You should be looking at growth stocks towards the mid to late phase of the business cycle, as the aim for growth stocks is to buy low and sell high. Generally, a company is worth its least towards the end of its business cycle. The type of company is also important for growth stocks. Investing in an old company that has already reached its peak is a bad investment for growth stocks, as the company is unlikely to grow as it has reached its final form. The companies to look out for at the moment are tech companies. At this current time, the growth of tech companies seems endless. We can also see, at this time, the dividend yield of tech companies seems to be lower than most, which indicates that the company is spending its profits on reinvestments to drive future growths. And if you're still really not sure on who to invest in, some growth stocks have even just spelled it out in their name, such as the Vanguard Growth Index. Now let's look at some advantages of each kind of stock, starting with value stocks. Value stocks are an easy way to gain passive income. The dividend yield, which is generally paid out quarterly, is a great way to build it in the long term. Another great thing about value stocks is that you make money even if the company doesn't grow. And if the company does grow, well, that's just a bonus. Value stocks are also very low maintenance, as they are long-term investments. Generally, with a developed company, over the long term it can ride through the bumps in the stock market and stay around the same price. However, this doesn't just mean you can be lazy. No company will stay strong forever. It's the job of the investor to sell off their stake in the company when the risk of loss becomes too great. And my favourite part of value stocks is the opportunity to get compound interest. If you reinvest your dividends back into the same company every time they're paid out, you will begin to experience compound interest. If you want to see how powerful compound interest can be sure to check out my video that I'll link in the top right corner. Now, moving on to growth stocks. What are the advantages of these? Well, firstly, your return on investment on a growth stock will generally be higher than that of a value stock. Value stocks can take decades to repay themselves, but with a growth stock, it may only take a couple years. Another advantage of growth stocks is flexibility. There is no reliance on long-term stability, as you can jump from a company to another company every once in a while, and just ride the upward trends for short periods of time. This could mean even changing different types of businesses based on market trends. This also gives you a chance of higher returns, as the growth of a company generally grows faster than a dividend yield of an established company. Finally, a growth stock has a high reinvestment rate. This means that the company is fueling its own growth in hopes that the money that it's not giving to its investors can be used to benefit the company as a whole. So, to wrap things up, which of the two is better? Personally, I prefer the safer, more long-term option of value investing, as it has two options for growth: the reinvestment of your dividends, as well as the chance of growth of the company. Creating passive income is beneficial towards freeing yourself from a 9-to-5 job, but the decision really is yours. If you prefer a more active but riskier role, then growth stocks are great for you, but if you prefer a more long-term passive role, then growth stocks can be a good choice. Thank you very much for watching this video. If you like this video, be sure to like, comment and subscribe for future videos. Also check out my other videos for great advice on how to improve your investing skills and financial development. This is Ken from Investing Made Easy, and I'll see you.